Corporate finance practice problem using one note. Expected value and net present value, even yearly cash flows. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote and would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side in the Practice Problems tab, then in the 1326 Expected Value and Net Present Value, Even Yearly Cash Flows tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Presentations up top will be mirrored in the text area down below, same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we then have our information up top. We're going to go through then the calculations on down below. So we're going to look at a capital budgeting type of situation and apply our future forecasting kind of analysis to it. We'll also take a look at the present value calculation related to it. So typical scenario when we have a capital budgeting type of situation is that we're going to imagine the initial cash outflow up front. In this case, that being $15,550, so that we can then get cash inflows in the following year. We're going to imagine, or in the following years, and because it's going to be affecting multiple years into the future, then we can apply our present value type of techniques, which would include the net present value and the internal rate of return. We're imagining here that we're going to put money into some type of equipment, which will then have a 5-year life. And we are also going to imagine that during that 5 years that the equipment will be in use, we're going to have either savings or cash inflows. We're going to have a cash benefit that will be even over that time period, so that we can then think about our analysis. We'll do our analysis process to think about what the yearly cash flows will be, and then use that to basically get to our expected value on a yearly basis. Note, we're going to see a future problem in a future presentation, which will be slightly different. In other words, we could use this technique here to try to think about what the expected values will be in multiple different ways with these longer term capital budgeting type of projects. For example, here, we're going to imagine that we have the yearly cash flows being the same, and then we can basically figure out what we believe the possible yearly cash flows will be, then get to our expected value, and then we can apply our net present value to that expected value for the 5 years. That's what we will do here. However, if the cash flows were not expected to be the same, then we could think about another type of method. We might then have to do, for example, present value calculations for each of our different scenarios, so that we can then get to basically a bunch of different present value type of numbers that we can then apply our probabilities to, and we'll talk about that kind of method in a future presentation. You can also think about a system where you might say, well, I'm going to use this kind of approach for each year within the capital budgeting process. So I might say, what are the cash flows going to be for year 1 after the equipment? I don't know. Let's do this type of approach and give some estimated answers and do our probability kind of assessment for year 1, then do the same thing for year 2, same thing for year 3, and so on, getting an expected value for each of the years that the future cash flows will generate, and then we can use that to do our present value calculation. So we'll do those two kind of formats. We might see those in future presentations. Right now, the assumption being for this capital project, we have 5 years. The cash flows will be even coming in for those 5 years, and then we'll do our kind of probability analysis to figure out what those even cash flows would be. We've got the not good, the okay, good, very good. Notice the names on the left-hand side are not important. What's going to be important is what we believe the returns will be. So we believe that the not so good situation would be $4,500 yearly for 5 years. Okay, $6,000 yearly for 5 years. Good, $8,500 every year for 5 years, and very good for the $10,000 every year for the 5 years. Then we're going to assign our probabilities. Where would this information come from? Possibly prior machineries that we have put in place, and then projecting out into the future in terms of what the current economy basically looks like. This is a way to group our ideas so that we can get to an expected value so that we can basically move forward. Of course, looking into the future, we don't know. We're just making our best guess here. We're then going to take our probabilities. We've got the 20%, the 30%, the 30%, and the 20%. Calculating those out, we got the 4,500 times 20% is 900. The 6,000 times the 30% is going to be the 1,800. The 8,500 times 30% is the 2,550. Then the 10,000 times the 20% is going to give us the 2,000. The 2,000, and then of course the percentages have to add up to 100%. That gives us an expected value for the yearly cash flow that we're assuming. That's what this is for. For the yearly cash flow for 5 years is 7,250. Now that we have that expected cash flow, then we could go forward and say, let's do our present value calculation. This is where we have seen in basically a prior section where we focused a lot on these present value kind of calculations for a capital budget. So if you want to spend more time on them, you could go to a prior presentations where we spend more time on them. The new thing here, of course, is to get to this number. So this number is what was kind of assumed in our prior sections, right? In the prior sections, we basically assumed that we knew, or we had already come to what we believed the future cash flows would be. Using that information, we then calculated our net present value. Now, of course, we're taking a step back here and saying it could take more detail, of course, for us to figure out what we believe the future cash flows will be. And this is one method that we might take in order to think about what we believe the future cash flows would be. You could imagine these type of situations can be very difficult to organize if we're kind of trying to think about what things to invest in, because obviously many people might be involved. It's going to have a long-term process that will be involved. We're using estimates that will be involved, and there might be people that have, invested interest in one area or the other. So we want to do as much of a systematic approach as possible to be able to compare and contrast different methods and be able to explain where it is we got to the numbers as much as possible, so that we can have a good debate about, what's the best place to put our money. So then we got this information. Now we're going to say the cost of capital is 14%. That's our discount rate. Let's calculate the net present value now with that 14%. That means that if the net present value is over than 0, the 14% is included in it, which includes our return. So if 14% is the hurdle rate, the cost of capital, if it's 0 or above, then we've cleared the 14% and may then accept the project. So we're going to have years 0 through 5. We're going to put our cash flows. Note that we do have an annuity cash flow here. In essence, you might say, hey, this is an annuity. Why don't I do it with an annuity calculation? We will do that in a second here, but let's just do the standard present value kind of analysis. If these payments, of course, were different every year, then this analysis would work in that format as well. So we're going to say the first outflow was that 15.5. That's going to be the outflow that we put down for the purchase of the equipment. And then we figured the yearly inflows for the next 5 years, the life of the equipment, are going to be even at the expected value of the 7,250. That's this 7,250. Then we can do our present value calculations. Remember that a few sections back, we focused a lot on simply present value calculations. So you could do these with tables, you could do them with a formula, you could do them with Excel. We're going to focus in on Excel here. If you want to look at them in different ways, then take a look at the present value calculation area. This is going to be present value of 1 calculations. I'm going to do it on this first tab, even though we're at time period 0, so that we can then copy it down. If we were to do this in Excel, we can easily copy down the formula. So we got the negative present value. The rate is going to be the 14%. Notice it's an absolute reference in the cells by the dollar signs before the B and the 13. That means when I copy it down, that cell will not move, so the 14% will be the same for each of these cells. The number of periods will be 0. Notice I referenced a cell to the right-hand side instead of typing in 0, so that I could copy that down, and the relative cell will go down, comma, comma, because it's not an annuity, but present value of 1, and we will contrast that to an annuity calculation down below. Future values, the 15.5. The result is the same because we're at time period 0. But if we copy that formula down, then in period 1, the 7,250 discounted at 14% back 1 period or 1 year will be 6,350. And then in year 2, the 7,250 discounted at 14% back 2 years will give us the 5,579. The 7,250 discounted back 3 years at 14% gives us 4,894. The 7,250 discounted at 14% 4 years will give us the 4,293. and the $7,250 discounted at the 14% 5 years will give us the $3,765. Adding that up, we get to the $9,390. Because this is a positive number, that means we cleared the hurdle rate or cost of capital of 14%, might then consider taking on the project. If we want to know what the actual rate was, possibly so we can compare it to another project, we can look at the internal rate of return, which could be calculated in Excel like this, equals IRR, and then just this series of numbers, negative outflow up front, and then all the inflows, and that would then give us our value, which would be the 37.13%. That's the rate at which, if we did the net present value calculation using, we would end up with a result of 0. And then we could do the same thing because it's an annuity. So just, you might be saying, hey, why don't I do an annuity calculation here for this portion since these payments are all the same? Notice that in this situation, if you could do an annuity, you can always do a present value of 1 with these type of situations, this type of calculation. And sometimes you can do an annuity. So in other words, you can always do a present value of 1, and then sometimes, if they're all the same, of course, then you can do basically an annuity calculation. In practice, it's actually nice to do the present value of 1s because it's easy to do in Excel, and you actually get a nice fuller picture of what's happening in these capital projects. But in a book problem, they will often limit you and they might try to take away your calculator and whatnot. And so therefore, they need to limit the calculations just for logistics purposes to get it done within a test type question time period. And so that's when they might do the annuity for time reasons in that case. If you have Excel, in other words, I think this format is actually better to explain your position or what's going on in the capital project and debate on it. But the annuity calculation would be looking like this. Negative present value would pick up the rate, which again is that 14%. And then we'd say comma, number of periods, which would be 5 years, and then comma, the payment, which is going to be the annuity payment of the $7,250 for each of the periods. That would give us the $24,890. That would be the inflow or present value of the inflows. If we compare that to the investment or outflow at time period 0 for the purchase of the equipment, $15,500, we then get back to that $9,390 once again. So we can also calculate this net present value that way. Also note that the annuity formulas, like I say back in the prior sections when we talked about present value calculations, you can do that with a table. You can do that with formulas. If you want to get more information on how to do that, take a look at the prior sections.